Welcome back, Flare community. We're going live. This is the Real Vision stream. So I think it's going to get started very soon. I was a bit late to this. I didn't know that it was actually going to be streaming this so fast on YouTube. I thought it was going to be a Twitter space, but for those interested, I thought we could watch it together and sort of see all of the interesting conversation that's about to come. Now, Santiago, he's going to be one of the co-founders, and he's very knowledgeable on all things Flare. So it's going to be quite interesting. I think we're going to get a bit more of an open discussion about what is going to...
If we want to change the outcomes,
let's jump in
for this really screwed up world, where our wages don't go up, where we're being replaced by...
In fact, we can maybe just stop this for now because...
debasement of assets, so we can't afford...
Nothing interesting going on there. It's basically just doing an intro. But, you know, I think this is going to be an interesting conversation because there's a lot of people that aren't really familiar with the Flare network. But Santiago, as I was saying, he really is in tune with the Flare network. So hopefully we get some new and intriguing sort of questions from him, other than the basic or the generic ones that we normally get from these kind of interviews. You know, what is the Flare network? What is the FTSO? All of that good stuff. We're already very familiar with that. And yeah, it looks like we're going to get a bit more of a deeper conversation here from Santiago. Again, they're just running this intro. But it is what it is. How's everyone doing today? We've got a couple of people in the chat. Please feel free to drop a message. Right, let's jump in. I think it's good to go.
Attorney General says Bitcoin miners with a 30% electricity tax. And by the way, serious jitters in capital markets on concerns about the banking sector. Welcome to Real Vision Crypto Daily Briefing. I'm Ash Bennington. I'm joined today by friend of the show, Santiago Velez. Santiago, welcome back to the show. Ugly news flow day.
Ash, thanks again for having me. This great times, Empire striking back. It's going to be a great show.
Well, you're still Luke Skywalker to me, Santiago. Lots to cover here. Let's jump in and take a look at the price action. It's fair to say it's been a brutal 24 hours for crypto markets. More than $70 billion has been wiped off the value of crypto. The total crypto market cap has fallen 6.5% on CoinGecko, way below the $1 trillion threshold. Let's start with some important news on the macro front. The U.S. economy added 11,000 jobs in February. That's more than expected, although not nearly as high as the spike we saw the previous month in January. Unemployment ticked up 3.6%. That was also above expectations, although earnings grew by less than expected. Moving back to crypto markets, Bitcoin fell below the key psychological level of $20,000. That's the lowest price in 2 months. Bitcoin is down nearly 6% over the past 24 hours. The loss on a trailing 7-day basis has hit double-digit percentage change. According to blockchain security company PeckShield, some $1 billion worth of Bitcoin and wallets associated with U.S. law enforcement was moved onto crypto exchanges earlier this week. This might be adding to the selling pressure that we're seeing right now, as it suggests authorities could try to cash out Bitcoin that they had seized, obviously, in criminal and civil forfeitures and seizures in the past. Meanwhile, Ether is trading in line with Bitcoin. The current price of ETH is just over $1,400. That's a 2-month low as well, with double-digit percentage declines on ETH earlier this morning as well. I believe that's on a 7-day trailing basis. Santiago, lots to digest here. What's your take on this market?
Well, frankly speaking, if you've been in this market for long enough, you see that these cycles tend to repeat themselves, and we are definitely in a continued bear market and likely to go sideways with lots of volatility. So expect that for the foreseeable future. The tide is going up. Liquidity throughout the entire financial system is evaporating. Financial conditions are tightening, and we're going to keep seeing who's not wearing pants. So all par for the course. Buckle down.
Yeah, I think you said it beautifully there, Santiago. So listen, let me talk about something else that's very much on my mind right now, and that's what's happening right now in the banking system. You alluded to it in your comments there. This, to me, really is the question of the hour. This story begins yesterday with a very prominent bank in the tech world called SBV. That's Silicon Valley Bank. It trades under the NASDAQ symbol SIVB. That's Silicon Valley Bank Financial Group, or I should say, traded under the ticker symbol SIVB as it's currently suspended. It hasn't been delisted. Let me not overstate the case, but it has been suspended. And just in the last literally the last 5 minutes here. Let me just read the headline. This is direct from CNBC.com. Silicon Valley Bank is shut down by regulators, FDIC, to protect insured deposits. Here's the lead. Silicon Valley Bank has been closed by regulators, which have taken control of the bank's deposits, the Federal Deposit Insurance Corporation announced on Friday. You can go up to the FDIC website. The headline there is FDIC creates a deposit insurance bank of Santa Clara to protect insured depositors of Silicon Valley Bank, Santa Clara, California. Okay, why are we talking about it in crypto? This is a big story for reasons that I'm going to allude to. But first, let me give a little bit of context on what happened with SBV, because this really gives you the broader context in a macroeconomic sense. So yesterday, the bank announced a $1.8 billion after-tax loss. They announced they were attempting to raise $2.25 billion in new equity. CNBC reporting this morning that they were unsuccessful in their ability to do it, and they were attempting to sell the bank. The shares plunged some 60% yesterday. Trading was suspended. And now this story is about much more than this one bank in San Francisco. Shares in other tech-exposed banks like PacWest also plunged double-digit percentages on the news. I'm looking right now, PacWest on my screen. Wow, trading off nearly 25%. That trades under the symbol on NASDAQ, PACW. So again, trading 25% down on the day after taking a beating yesterday as well. Here's the macro upshot of it. This is why we're talking about it on this show, on the crypto show. This is why we're leading the show with it. Yesterday, we saw the worst moves on the KBW NASDAQ Bank Index since the pandemic. That's 3 years ago, March of 2020. This morning, the 2-year Treasury yield moved in its most severe fashion since 2008. This is a huge drop in yields. That means prices are spiking. People are moving out of equities and into fixed income. Presumably, that's why you'd see the yield drop that dramatically. It's like 40 basis points. It is a massive move. I was tweeting about it this morning. So what's this all about? This is about a run on deposits. We talked about this with Silvergate. I should say Silvergate was a sponsor of Real Vision Crypto in the past, just to make that disclosure. What does that mean? So this is the deal. When banks lose deposits, they need to sell other assets to make up for the shortfall in capital they have. When they sell their safest assets, U.S. Treasuries, they need to mark those assets to market, on the losses. There's a great article about this. If you're looking for the explainer on what's happening here to try and understand, to try and get your head around these broader macroeconomic issues, take a look in yesterday's Wall Street Journal. Jonathan Weil and Ben Eisen wrote this fantastic article about this called "Banks Lose Billions in Value After Tech Lender SBV Stumbles." I want to read from you this because they did an excellent job of summarizing it. These are guys with serious backgrounds in accounting and really understand the macroeconomics and also what happens in the banking sector. Quote, "Banks don't incur losses on their bond portfolio if they are able to hold on to them until maturity. But if they suddenly have to sell the bonds at a loss to raise cash," that's exactly what's happened here, "that is when accounting rules require them to show the realized losses in their earnings. Those rules let companies exclude losses on their bonds from earnings if they classify investments as, quote, available for sale or held to maturity. Sometimes the losses catch investors by surprise, even if the problems has been slowly building and fully disclosed for some time. At SVB, unrealized losses have been piling up throughout the last year and were visible to anyone reading its financial reports. The Federal Deposit Insurance Corporation in February reported that U.S. banks' unrealized losses on available for sale and held to maturity securities totaled, wait for this number, $620 billion as of December 31st, up $8 billion a year earlier before the Fed's rate push began. The Fed's rate push, that's what this is all about. You've heard Raoul Pal say it here on Real Vision many times. Crypto is macro, macro is crypto. You just got an opportunity to see that transmission mechanism, how that works between macro financial conditions, the banking sector, and what's happening in crypto. Boy, Santiago, this is just a massive story. I know that's a lot, but that's the background. What are your thoughts on all this?
Well, I think they got powelled. We've seen the greatest rate hike in history. in the shortest period of time. And you can't absorb that amount of tightening without losses. And, for those who may not understand, bonds are inverse to the rates. So the value of the bond and that collateral goes down as rates go up because there's a better deal in town. If I'm an investor and I'm going to buy a bond from one of these banks that's liquidating and they had that bond at 1% when they bought it, why would I buy that? I'm going to buy it at 90 cents on the dollar, 80 cents on the dollar. So it becomes a huge loss on their books.
Right.
And ultimately, it's kind of a stress on confidence, which is the main factor holding the banks together. It's the confidence that people have that their money is safe and it's going to be there when they need it. And when it all starts unraveling, that's when you get a bank run, and that confidence is shattered. So, I think they got powelled.
Boy, Santiago, you said that absolutely beautifully. You made so many important points there. First, explaining the inverse relationship between prices and yield, absolutely critical to understanding this story. And second, the idea of confidence. I would only add one thing to that point, and that's this elegant article from the Wall Street Journal, which uncovers this so beautifully, which is this. One of the things that's maybe a little bit surprising here, people might say, hey, look, we've all known that yields have been rising, right? This isn't a surprise. We know that quantitative tightening has been very much on the cards for a long time now. Why does this stuff happen all at once? And what the article describes is this is an accounting feature. This is the way mark-to-market accounting works. You may ask, why don't these things kind of decline slowly over time? They don't. They go like this, cliff face down when something hits. Why? Because when a bank has to liquidate some of those assets, that's when they have to take those mark-to-market losses. That's when those losses show up. That's when they take the hit. And that's when you get these things that seem to happen out of left field. These have been building under the surface for a while, exactly as you described, Santiago.
I think it's just to quickly mention, it's probably one of the reasons why there's remains risk in stablecoins, because a lot of stablecoin issuers take similar approaches where they get short dated securities or commercial paper. But eventually, it really comes down to the rate and the amount of yield that they can generate and the confidence in a particular run. So it's important to correlate what's going on in the banking sector with what could potentially occur in stablecoins and in crypto writ large.
Yeah, I should say, Santiago, this is a huge story, but there's also a lot of other news flow to talk about this morning. The New York Attorney General has claimed that Ether is a security. The assertion came as part of a lawsuit against the crypto exchange Qcoin. The lawsuit alleges Qcoin is violating securities laws by offering tokens that meet the definition of a security without registering with the Attorney General's office in New York. And those tokens include Ether. CoinDesk reports this is the first time an official, in this case, a state level official, the New York State Attorney General, who has filed suit in the Supreme Court of New York, has made this claim in a U.S. court. SEC Chair Gary Gensler has hinted at it as well, but has not made the claim yet in any formal lawsuits. Santiago, if this were to become a legal precedent, and that is still a big if, and it's a long way away based on the flow, it seems to me at least at this time, it would have massive implications for the entire crypto industry. What do you make of it?
I just think it's the empire striking back. This is the coordinated effort by lots of three-letter agencies at the federal level and now at the state level, to essentially rein in crypto into the regulatory framework and use whatever tools at their disposal to do so. I think that this could be a legal precedent-setting type of case. It will likely be challenged all the way, obviously. I think it hits at the core of what yield means, in particular for proof of stake type networks. And it could be that the way exchanges handle that facilitation of yield on behalf of delegators could be at the root of the case. But we'll have to see. There's a lot in the complaint to digest, but it's a big deal.
Yeah, we should point out, of course, neither you nor I are lawyers. You, of course, are a nuclear engineer. I'm just the dope who asks questions on Real Vision. But listen, the important thing I think to note about this case is that this is a state case. So this doesn't have binding federal precedent. This has been filed in the state of New York, in the Supreme Court of the state of New York. This is not in the Southern District at the federal level. That's a distinction we'd love to have some lawyers come on and discuss with us in more detail and unpack there. But unfortunately, Santiago, this is not the only negative news flow of the day. Ether is not the only major cryptocurrency that's been hit with a negative headline today. U.S. President Joe Biden's budget proposal features several crypto-focused measures. The most notable one includes a 30% excise tax on electricity being used to mine Bitcoin. It would start off at 10% before going up to 30% within 3 years. The aim is to reduce mining activity in the US. Quote, an excise tax on electricity usage by digital asset miners could reduce mining activity along with its associated environmental impacts and other harms. Close quote. Santiago, while it's by no means a certainty that this proposal will become a law, it's bound to send a chill down the spine of US Bitcoin miners. And I would add, probably more generally, the cryptocurrency community here in the United States.
I think this is at the crux of the ESG movement in general, is the idea that certain kinds of activity, uh, in particular electrical consumption, is good activity versus bad activity, and it's a very subjective kind of assessment. And so the problem with this is whether or not miners who access a common utility like the grid should be subject to these kinds of excise taxes versus, say, a miner who co-locates and generates their own power. Would they also be subject to the same kind of tax? And so this is definitely going to hit on a lot of constitutional issues, on property rights, on First Amendment. If you're talking about node operations or hashing operations, so this has broad implications. I think that number of 30%, if you look, it coincided with a proposal to raise capital gains taxes also by some upwards of 40%. So this is kind of a shot across the bow to Congress, and I think that it's kind of the beginning of a negotiation to try and raise revenue federally across the board. So this is more tightening only at the fiscal level. So we can continue. We'll expect to see more liquidity leave the system, and tax policy is another way that happens.
Fiscal tightening to be sure, but also this definitely looks like something that's very much targeted at the crypto industry. And they're talking about reducing mining and not just merely raising revenue. Look, we don't do political sort of arguments here on Real Vision in 2023. No matter what you believe politically, there's a network out there on cable television that will tell you you're right. We don't like to have those conversations, but it's pretty clear, I think, that the Democratic Party here in the United States is positioning itself in a way that is clearly not terribly friendly to crypto. Maybe I'm understating the case, maybe I'm overstating it, but there are a series of proposals here on the table that do seem to be making this point that this is definitely moving in a political direction. Unfortunate to say. By the way, one other story that I wanted to touch on here before we bring in Hugo: the U.S. Department of Justice has launched an appeal against the court decision to allow Binance US to buy Voyager digital assets. Various regulators, including the SEC, have opposed the acquisition. But earlier this week, the judge in the crypto lender Voyager's digital bankruptcy case approved it. This deal is worth more than $1 billion. Santiago, lots of people have been eagerly following this case. Those who breathed a sigh of relief, I guess it was yesterday, may have done so prematurely, it seems.
Well, I think there's some hope on the horizon for people who had exposure to Voyager Digital, and I think they're happy to hear that this judge voted in their favor. That there's some light at the end of the tunnel. But I think there's a bigger trend, which is this idea of companies that have any kind of association to Binance in terms of the international company, and that playing into the whole tech narrative. We have Silicon Valley companies who have deep ties to China. We've seen Congress bring that up in testimonies. I think this will likely play into that narrative at some point, but we'll have to see. But it's definitely good news for people with exposure to Voyager.
Yeah, I think that's well said. And obviously, we're going to have to wait to see the outcome of this appeal before we know where this is going to land, particularly with, in relationship to this Voyager bankruptcy case and where those assets will go. Okay, viewers, join us in the conversation. Put down your questions in the chat wherever you're watching. We'll ask the best ones on air later in the show. Remember, Real Vision members take priority, but the good news is Real Vision crypto membership is free. With that said, let's bring in our next guest. Hugo Filion is the CEO and co-founder of Flare Network. Welcome to the show, Hugo.
Hey, thanks for having me.
It's a pleasure to have you here. I'm going to let Santiago take it away from here. I'm going to hang back and enjoy the show. I'll see you guys soon.
Hugo, great to see you again. For all our Real Vision subscribers, viewers, check out the interview we did with Hugo a little over a year ago on the Flare network to do a deep dive on what's being built. But today we're going to do a quick recap, explore what Flare is. Thanks for coming on, Hugo.
Hey, Santiago. I don't feel like I'm really running a blockchain project at the moment, just a risk management project trying to hop and skip between different US banks. So yeah,
Yeah, it's a tough time to be building a blockchain at layer one and try to solve problems in this environment. But if you can do it in this environment, then I'm sure you'll fly when things turn around and get better. So, good luck to that. That's good job. So, let's start off by asking, what is Flare? Give us a quick rundown of the tech stack and see if you can try and differentiate it from other L1s and the kind of problems that it might be solving in lieu of, why not just use Ethereum, for example?
Sure. So look, Flare is an EVM based layer one blockchain, but we're trying to solve the problem really of usefulness, i.e., utility. So just to kind of backtrack on that, right now, many of the newer L1s and L2s are trying to solve scaling. This makes transactions cheaper and allows dApps to scale. There's a worthy and necessary ambition, but once solved, in reality, that becomes a commodity technology, i.e., pretty much once there's a great scaling solution, pretty much every blockchain will probably adopt it. Doesn't necessarily give you a lead or some kind of defensible moat. What we're trying to solve for is utility. And how we're trying to do that is through building an L1 smart contract platform that's purpose built to acquire data from any open external source. Um, and why are we doing that? Well, aside from crypto as an alternative asset class, which it obviously is, and today, and the unfolding of the fiat system, or maybe unraveling of the fiat system over the longer term, is showing us that. But DeFi is really the only other blockchain product, other than being an alternative asset class, that has meaningfully scaled to date. But its use cases are pretty limited due to the limitations of L1s. I also question how much in DeFi is actually decentralized finance, i.e., finance in the traditional sense of financing economic activity versus speculative activity. Our belief is that we need dApps that play a larger role in people's lives. For this to happen, those dApps need data, and that data has to be decentralized, and today has to be decentralized and secure. And today, there's really no Oracle product that delivers off-chain data, regardless of what source it comes from, that is decentralized and secure and sort of robust to risks. Um, and so Flare's goal is to make blockchain more useful by offering developers a layer with access to high integrity decentralized data from other chains and the internet. So this allows engineers to develop applications that securely connect Web 2 functionality and utility to the Web 3 ecosystem.
Wow, lots to unpack there. So let me just deconstruct a couple of things I think I heard. First of all, the EVM, it's the Ethereum virtual machine. And just for our viewers to understand, that doesn't mean you're using Ethereum. It means you're just using an emulation of a computer to process smart contracts. And it happens to use the same programming language that Ethereum uses, like Solidity, for example.
Sure.
So
Sure.
the Ethereum virtual machine, it's just a separate kind of software stack that
Like
Flare
installing a version of Mac OS.
Mhm. And so that's the first piece. The second thing I heard that I think is pretty important is this idea of bringing in data from the outside world. Blockchains right now are their own kind of closed universes. They don't know what's happening outside of them, and they just process transactions and they move along. But what you guys are trying to do is essentially bring in data from other blockchains, the state of Bitcoin or XRP or any other ledger, as well as data from the internet, right? It could be data
Yeah.
from Twitter, it could be data from a stock feed, commodities market, real world data. Is that correct?
Absolutely. Could be Twitter data, could be social media data, TikTok data, um, any open index, any open data is fair game for Flare.
Yeah, and that's a challenge, right? Because to your point about how do you make sure it's authentic, that it's provable, and that if you're going to take action on it, meaning a smart contract is going to process as some value, that data has some integrity to it. And so you've devised a Oracle system which decentralizes that process of ensuring that the data is delivered with integrity. Is that correct?
So I think should I run a bit through the kind of general outline?
Mhm.
So as I said, Flare is an EVM layer one blockchain. It has two data acquisition protocols that are secured directly by the network, and this is really important. This is why it matters. We're leveraging the scale of an L1 for the decentralization and security of the data acquisition protocols. This is extremely different to an Oracle that's built on top of a blockchain and therefore cannot really decentralize, cannot leverage these many parties and but potentially very large amounts of value to secure that kind of data. So the two protocols, first is for price and time series data, so that's called the Flare Time Series Oracle. It delivers highly decentralized time series data feeds to dApps. Currently, those are digital asset price pairs, but it could be any index, could be carbon emissions, can be anything that moves over time. Essentially anything that doesn't have a single source of truth. So this has currently, at the moment, we believe that's the most decentralized Oracle in the space. It's also, one of the most accurate. Currently updates every 3 minutes, but that's a parameter choice that can be as low as 30 seconds. Second is called the state connector, and that is for blockchain state. So as you said, understanding what's happened on Bitcoin, understanding what's happened on XRP, understanding what's happened on Ethereum, really, being able to prove what has happened on another chain. That's for blockchain state and Web 2 data. So being able to prove a single source of truth API that is quasi-deterministic onto Flare. So you send a tweet, you leave it up for half an hour. During that period that you leave it up, we can prove that you sent that tweet, and we can prove information about that tweet. We can prove the content, we can prove how many retweets it has, how many likes it has. If you delete it, obviously past that point, we can no longer prove that. But during the time it's up, provided it's up for long enough and the network's able to come to consensus over it, we can prove that data onto the network and an application can use that. And that extends massively across basically any open internet data. So that's the Flare Time Series Oracle and the state connector. Together, these protocols really give developers access to high integrity data. Really can't get this on any other blockchain. And that's why we call Flare the blockchain for data.
So is this kind of like connecting the Internet of Information and an Internet of Value so that you can make more interesting kind of decentralized applications? Is this really the first instance where we've had a chance to merge those two networks together and build? And what kind of use cases do you think could come out of this?
Yeah, so it's an EVM layer one, so it can have its own ecosystem of applications, and those applications can be, I guess, a number of things. So it can be referential to the network itself, so DeFi on the network. It can be referential to other blockchains. So those can be things like bridging applications, relay applications, secured by Flare. Why would they be secured by Flare? Because Flare can prove what has happened on each network. It can slash relay nodes that are staked on Flare accordingly. So dApps on Flare, dApps built on Flare for interoperability, and then dApps that access Web 2 data. And then, so the model's not so fixed. It can be on the chain, built on the chain, built for the chain, and also can be built for the chain and then relayed to other chains through relay protocols. So it's kind of like a multi-use tool to try and sit in the middle of all blockchains, but also have its own ecosystem. So use cases are crypto interoperability. So really creating good bridges, good relays. But then things like, okay, so I want to monetize a game that exists in Web 2. Maybe it's free to play, but maybe I want to have some secondary level. Maybe I want to have micropayments. Maybe I don't want to have to process credit cards because it's a nightmare. I can just allow Flare to absorb the API and for users to basically make microtransactions between each other, and I can take a cut in the smart contract. Those kind of things.
So do you see a scenario where, I could tweet something and earn a payment through Flare? That kind that
Absolutely.
kind
I see affiliate marketing as a really interesting. It's essentially affiliate marketing, right? Someone puts up a job and says, we've got $100,000 for to promote this product. For every 500 retweets, we'll give you $1. That kind of thing. And that can be administered directly on the network through proving, you know, proving from the Twitter API, assuming it remains open source, that has happened.
Excellent. Now, I'd like to kind of highlight the distribution mechanics of Flare because it was a very unique approach, and it was arguably one of the largest airdrops in crypto history. Can you talk a little bit about that and why the decision was made to do it in this way?
Yeah, absolutely. So Flare started life as essentially a network for chains that don't have smart contracts. So Dogecoin, Bitcoin, principally XRP. And so we chose to distribute the token to XRP holders. Flare then morphed over time to become a very, very much larger project with very much larger ambitions. And so we have essentially a public token pool, which is being distributed over 36 months. 15% of that was distributed to the original XRP holders, and then the remaining 85% is being distributed to anyone that essentially obtains the token and wraps it. So, if they're using the token on the network, then the network will distribute the token, the remaining portion of that airdrop over 36 months in equal installments to people that wrap the token.
And how many, do you have any idea of how many tokens actually, excuse me, exchanges participated in this distribution? And obviously, it went to individual wallet holders.
So, individual wallet holders, more than 100 exchanges, every major exchange, barring FTX because they went bust. Um, yeah, every major exchange. So, Binance, Coinbase have publicly said that they will distribute the token, and every other major exchange.
And so, given this distribution mechanism, can you differentiate Flare from, say, Ethereum and how it's different from, say, a traditional proof of stake and the yield that comes out of proof of stake? How are they different, and why don't you need to worry about some of the things that Ethereum might have from a regulatory perspective?
So I don't know what you need to worry about Ethereum from a regulatory perspective. To be clear, I'm not certain that proof of stake is an issue. But regardless, at the moment, people are delegating to the oracles, so they're not staking currently. Although there will be an element of staking in the future, but that'll be built in a different manner. So I'm sort of not really cognizant, and we have discussed this. We have a securities lawyer on team. Have had a securities lawyer on team from day one. So I guess we've not found a strong argument against proof of stake. There are good arguments for collective investment schemes where you essentially say, um, stake your token to me, I'll give you a staked version of the token, so a liquid staking token, and then I'll stake the token on your behalf.
Hmm.
That's very much a collective investment scheme. Probably. Whether it fits into the definitions of what a collective investment scheme is, I personally am not a lawyer, so I don't know. But that smells and looks a bit like that. I'm not certain that staking in its pure form, where the network is actually administering everything, sort of fits into that definition.
Great answer. Yeah, it's a tough spot, and it kind of points out, for anyone building in
Again,
this space, how to navigate
yeah.
this really tough environment.
Again, it's all completely undefined, and um, you know, are the powers that be are doing their best to leave it as undefined as possible.
Yeah, that's for sure. Awesome. Hugo, what else you want to let us, our viewers know? Where can people learn more about Flare, and what do you hope to see happen over, say, the next year in the development?
So I think you can learn about Flare.network, and our Twitter is at Flare Networks. I think I'll just jump on a couple of things. Just I often get asked, how do token holders participate, and there's obviously delegation to the FTSOs, so wrapping and delegating to the FTSOs. When you delegate to FTSOs, you can still use your tokens in applications. So you can essentially put your token in an application, specify to that application where you want that token delegated to, but still enjoy the rewards of that application. So that's very important. Then there's governance. Flare is the key voting token for the governance system. And then, of course, if you hold Flare and you wrap it, you'll receive a share of the airdrop over 36 months.
Awesome. We can find more information about Flare at flare.network and the Twitter
Yep.
hashtag at Flare Networks. So definitely
Yep.
a good follow. Hugo, thanks for coming on. We appreciate it. Best wishes in this environment. I have no doubt that you and your team will do a great job. Thanks for coming on.
We're very excited. Thanks so much, Santiago.
Excellent. So now I'm going to bring back in Ash. We've got some viewer.
Well, that pretty much wraps up the live stream. I thought it was pretty good. Santiago asked some great questions. A lot of it we already know, and I think this is the frustrating thing about being so involved in the network, right? We know these basics, and it seems like every time Hugo does an interview, and rightly so, he has to reiterate some of the fundamentals, but you never know. I think maybe I might try and get Hugo on the Flare community channel for a podcast myself, and maybe we can delve a little bit deeper into something like that, but who knows? I'm just putting that out there now. I'll try my best, but we'll see what happens. But anyways, regardless, I thought that was pretty good interview. But that's pretty much it, So I guess on that note, I'd like to thank you all so much for watching. Do have an incredible weekend, and take care. And until next time, I'm out.
We have liftoff.